Today on this module, we are going to be talking about stock picking and how to pick stocks in the New York stock market, in the New York Stock Exchange. Now, there are some ratios, financial ratios we need to look out for before we dive into stock picking. We need to understand what return on assets means. Now, a return on assets is, I'm going to give a very pictorial example for this. When a company is running, like a company that sells laptops, for example, when they start out, they get landed property, they rent it, either they rent it or they buy. They get the cashier and the needed necessary equipment, the plants and everything to run the business. Now, those things they've acquired are assets, right? Now, these assets that have been acquired, at the end of the fiscal year, what money, like how much has this asset produced for me? That is what the return on asset calculates. So you take the net income. Remember from the previous module, I said net income is revenues minus expenses. So revenues less expenses is net income. So when I'm taking out the net income, dividing it by the total assets that the enterprise owns, you'll be able to know the return on assets. A healthy company, based on the economic situation, you'll be able to give a figure on how, and based on and it depends on the industry or the sector we are in. So sometimes you might be seeing return on asset of 30%. So if you want to know how well the management is efficiently using the assets of a company, of an enterprise, you have to calculate the return on assets. If the management is efficiently using this asset to produce profits. Now, at the end of the fiscal year, if a bank, for example, are not efficiently using the equipment they've bought, the assets they've gotten efficiently to produce more profits, and more profits equates to more income. That's if they can efficiently reduce the expenses they make. So in general, by calculating the return on assets and looking at the income statement, you'll be able to know how well the management is handling this company. Now the second one is this current ratio. The current ratio is calculated with the current asset divided by the current liabilities. If you remember in this last module, I talked about having your current asset divided by the liability should be greater than 1.5. Yeah, this is a financial ratio that you need to know. So if you take out, this is a weak test. This is a weak test in the sense that I'm just taking out the current liabilities. The current liabilities are what the company owes within 1 year. Now, I'm taking the current asset dividing by the current liabilities. But an asset test for a company is when you take out the current asset divided by the total liabilities. Now, like I said, liabilities are divided into long-term liabilities and current liabilities. So addition of those two gives us the total liabilities. So if I want to add up the long-term loans, the long-term debt and the short-term debt together and putting it into this equation, that is the asset test for the company. So you'll be able to know how well the company is handling the management is handling the workings and the operations of the company. So if it is higher than 1.5, you are good to go. If it is 1, then it is weak. It means that if this is the weak test. If the weak test is 1, it means that for every current asset they own, they will use all their current assets to sort out all their liabilities. If it is 1, it means that, let me give an example. It means that they are having current asset of 500 million and having liabilities of how many? 500 million. 1. So they are using all their assets to pay up the liabilities. So, but if they were having current asset of 150 million divided by 100 million, So the liabilities are just 100 million and they're having current assets of 150. So it means that this will be 1.5. Fair company. It is fair. So, but if we are looking for figures higher than this, so that is a financial ratio that you must keep close to you. Now, the price to earnings ratio. The price to earnings ratio is used to know how undervalued, how cheap a company is. I use this ratio to identify undervalued companies. So the price to the PE ratio is calculated by the current price of that asset divided by the earnings per share. Now the earnings per share can be gotten in the financial statement of the company. So this is how you would know an undervalued company. Watch. The earnings yield is 1 divided by the price to earnings ratio. Now, the earnings yield gives us a rough ROI on the company, the expected return on the company. This is where you find major calculations, or this is where you find stock picks that are very, very good. You find the undervalued companies that are in their very bottom, and you are getting them at the most discounted price ever. See, when the earnings yield, let's say a price to earnings ratio is 5, right? The PE of a company is 5. Now, the earnings yield is calculated by 1 divided by 5 times 100, isn't it? So this is 20%. So we're having an earnings yield of 20%, right? Now let's reduce the PE ratio. I'm taking it to 2. So it means that I'm having 1/2 times 100, that's 50%. So it means that the rough return on investment on that company would be, if it was to be 2, I'll be getting 50%. If it was to be 5, I'll be getting 20%. The lower the PE ratio, the higher the earnings yield. So there are companies with lesser PE ratios. So their PE ratios are so low that you literally be getting them at the very discount, at the barest discount. So there are companies of having PE ratios of 1, 1.3. There are some companies are having PE ratios of just 1. So if I'm to do so, it means I'm getting 1/1 times 100, isn't it? 100%. Some are having below 1, 0.5. As we go through the next module where I will show you my screen, I will tell you some companies how you see companies having PE ratios of less than 1. So if a company is having a PE ratio of less than 1, it is 1/0.5 times 100. That's 5 times 10 raised to the power minus 1 times 10 raised to the power 2. So this is 5 times 10 raised to the power 2 minus 1, 2. That is 500%. So how do you expect this? By just knowing the PE ratio, having a lesser figure, then you'll be able to know how the earnings yield will be. So there is a website I want you to go when we start our next module. Once you put in these figures, it's like a parameter, you just put it in. You put the current ratio of greater than 1.5, return on asset of let's say 50% and above, then the P ratio lesser than 5. You'll be able to, you will see it will draft out a list of companies falling under these categories. Then you'll be able to pick them. They will not be up to 10 in the whole exchange. So over time, picking stocks will be next to nature to you. So the last thing I want you guys to know is the market capitalization. Now the market capitalization is like the rough is a valuation the market is giving that company. Apple as at 2019 was worth 739 billion dollars. That was what the market is valuing Apple at. So I want you guys to pick out companies that are falling under, they're having valuations of $10 billion and above, greater than $10 billion and above. But if you're a risky investor, you can contain risk. You can look for companies that are having less than $1 billion market cap. Now, there's a terminology I want you guys to understand. Any company having a price below $5 is called a penny stock. Any company having price below $5 is called a penny stock. Why? Because it's only a penny stock that is most likely going to have a very low PE ratio. It's only a penny stock that is most likely going to have a low market cap. So when they're having market capitalization is calculated by price times the outstanding shares. So the market cap is price times the outstanding shares. So if the market cap is going to be less, it's either the price is low or the outstanding shares is low. Now, if you know the laws of demand and supply, when there's less amount of something, the demand becomes higher and the price jacks up. But if there is more supply of this book, the price becomes less. So it is a win-win situation when we're having lesser price and lesser outstanding shares. So it means that the market cap will be relatively low. And when we're having low market cap, it is for those that are used to risk, that can accommodate more risk. So when an investor can accommodate risk, there's something about risk to reward. The more the risk, the more the reward. So these penny stocks are the ones that will fall under this category. They're always having market capitalization of less than $10 billion. So when they're having capitalization of less than $10 billion, you can now start looking at other ratios, other financial ratios. The current ratio, where is it standing at? The P ratio, what is it at? Then once you see those valuations, you'll be able to pick out companies that are very good. So it will not be risky. It will be less risky when you see that the current ratio is in a good place. It means that the management is managing this company very well, even though it is a penny stock and it is risky investing in penny stocks. But the management is handling the company well. So what do you think will happen when you get this company? Because you have confidence that since the management is handling this company well, just to have a current ratio of greater than 1.5, even neglecting the market cap and the price, you will see that you are with a good company. So it is always hard, and most of these companies are not popular. Now, I said throughout our lecture, I'm going to be giving you paradigm shifts. Now, when something is popular, when anything is popular, as a smart investor, you avoid it. When anything is popular, you don't go to it. You look for the less popular ones. Now, there's something that happens in price. Let me explain. When an asset, any asset, be it stock, be it gold, be it any commodity, crude oil, anything, when it is not popular, when nobody is talking about it, it is always down here. The moment it will be silent, nobody knows it here. Then suddenly it jacks up. Everybody starts talking about it. That this thing has gone up. Let's start buying. This is not the point you buy. The smart investors have gotten in here. So if you buy here, it is risky because there's a tendency that it might fall. So those that bought here are still safe. Warren Buffett calls it margin of safety. Margin of safety. safety. Now let me explain. BLNK, check out this ticker. Check out this ticker. I talked about it in module 1. BLNK, Blink Charging, they are in charge of is a company that does they create equipment that charges electric vehicles, right? As of May 2020, this company was valued at $1.38. May 2020. Nobody knows them. It wasn't popular. The smart investors got in here. 8 months down the line, the company was worth $64. 8 months down the line. So this is when it is popular. This is when people started buying. The current price, as I'm talking to you, is at $40. The uninformed ones, the unintelligent investors, they got in at. Now they're at loss here. But those that bought at this price, they are still safe, even if it gets to this point. They are still in profit. So the BLNK is a very good company. It has huge prospect and all. This company has done times 64, or if not more, in 8 months. So what do you think? This thing still has more potential. And if you know, President Biden is an eco-friendly person, and he is planning on reducing the greenhouse gases that have been emitted in the US. So he wants to put in a lot of investment in electric vehicles. Now, as a smart investor, you think outside the box. A smart investor will not just look at electric vehicles that are will soon be popular. He will look at the companies that are in charge of charging these electric vehicles, the semiconductors that are going to be produced for these vehicles, the copper. Copper is an element that is going to be used mostly in production of electric vehicles. Many of these things are meant to be looked at, and so you have to look at the companies that are affiliated with those things, producing those things. You see that everybody, when they think of electric vehicles, what are they thinking of? Tesla. They are thinking of Tesla, but Tesla in 2014 was $40. Smart investors got in here. Tesla, let's say 2 years down, no, in 2019 it was $40. In the next year, at the end of 2020, it became $900. Smart investors got in here. Now they are getting times. So you can see that whenever you are hearing electric vehicles, Tesla is not just the only electric vehicle in existence. There are a lot of electric vehicle companies that are in existence that no one knows yet. They are having very good valuations, very good P ratios, very good return on assets, very good current ratios. You'll be able to, even the margin of safety, when I mean margin of safety is when Tesla was at $40, it rose to 100, still there, then it jumped up to 900. Those over here, they have a margin of safety because the stock cannot just jump down to this price. It's not going to do that. Tesla can never get to $40 in this life. Tesla can't get to 100. It is more valuable than that. So over time, you would see that looking at these ratios will help you make independent financial decisions. So in the last module of this stock trading course, I'll be showing you the website you need to go to find out these amazing companies and great companies. So on this note, I will close the content for this module. See you in the next module.